Hey everyone, welcome back to Fiscal Beacon. I'm your host, and today we are solving one of the most common mysteries in personal finance. You get a job offer. The salary looks amazing. You do the math in your head, maybe you even start planning that vacation or that new car. Then, payday hits. You check your bank account. The number is significantly lower than you expected. You look at the email attachment labeled Pay Stub, and it looks like a code. It's a wall of numbers, acronyms, and confusing categories. It feels like the government and your employer are quietly taking a cut without asking. But here's the truth, they are. They are following a complex set of rules that, once you understand them, actually give you control. Today, we are going to decode your pay stub. We'll look at every single deduction, explain why it's there, and show you how to read it so you can budget with confidence. Let's start with the two most important numbers on the page. You need to memorize these two terms, gross pay and net pay. Gross pay is the big number. This is your total earnings before anything is taken out. If you make $5,000 a month, your gross pay is $5,000. This is the number you use to plan your budget, right? But gross pay is a lie. It's not the money you get to spend. The money that actually hits your bank account is your net pay. This is your take-home pay. It's what's left after all the deductions are subtracted. Think of gross pay as the size of the pie and net pay as the slice you actually get to eat. The rest is distributed to various stakeholders. And that brings us to the first major slice of the pie, mandatory taxes. These are non-negotiable. The government requires your employer to withhold these for you. You don't really have a choice here, but you need to know what they are. First, there's federal income tax. This is the money that goes to the federal government to fund things like national defense, infrastructure, and social programs. The amount withheld depends on your filing status, single, married, head of household, and how many allowances or dependents you claim on your W-4 form. Next, we have state income tax. Not all states have this. If you live in places like Texas, Florida, or Washington, you might not see this line item at all. But if you live in a state with income tax, like California or New York, this is a percentage of your earnings that goes to your state government. It funds local schools, roads, and state services. Now, here is where it gets interesting. There are two taxes that fund your future safety net, and they are often the biggest surprise for new employees. These are Social Security and Medicare. Together, they are often referred to as FICA, which stands for the Federal Insurance Contributions Act. You might hear people complain about FICA, but it's actually a huge benefit. Social Security is the 6.2% withheld from your check. This money goes into a fund that will provide you with income when you retire or if you become disabled. Medicare is the 1.45% withheld. This is your health insurance for when you turn 65. Here is the key takeaway. Your employer matches these amounts. For every dollar you put into Social Security and Medicare, your employer puts in a dollar too. It's essentially free money being added to your retirement and health safety net, even though you don't see it in your bank account. So, if your gross pay is $100 and you see roughly $20 gone in taxes and FICA, don't panic. That's the cost of doing business in the United States. Now, let's move to the second half of the pay stub, the benefits and deductions. This is where things get customizable. These are the lines that appear below your taxes. You'll see categories like pre-tax and post-tax. This distinction is critical for your wallet. Pre-tax deductions are taken out of your paycheck before taxes are calculated. This lowers your taxable income. Let's look at an example. Imagine you earn $4,000 a month. If you contribute $500 to a 401(k) on a pre-tax basis, your taxable income drops to $3,500. You pay less in income tax right now. It's like getting a tax break today in exchange for saving for tomorrow. The most common pre-tax deduction is your health insurance premium. You'll see this listed as medical, dental, or vision. You pay a portion of the cost, and your employer pays the rest. Because it's pre-tax, you're effectively paying for your health insurance with cheaper, pre-tax dollars. Another common pre-tax item is a flexible spending account, or FSA. This is money you set aside for medical expenses or childcare, again, using pre-tax dollars. Post-tax deductions, on the other hand, are taken out after taxes have been calculated. This means you've already paid income tax on that money. The most common post-tax deduction is a Roth 401(k) or a Roth IRA contribution. You've already paid taxes on this money, so when you withdraw it in retirement, it's tax-free. It's a different strategy, but it's still powerful. You'll also see post-tax deductions for things like wage garnishments, union dues, or charitable donations. Let's talk about the 401(k) match. This is arguably the most important line item on your pay stub if you want to build wealth. If your employer offers a match, it is essentially free money. For example, if your company says they match 50% of your contributions up to 6% of your salary, you need to contribute at least 6% to get the full match. If you skip this, you are literally turning down a raise. Let's do the math. If you earn $60,000 a year, that's $5,000 a month. If you contribute 6%, that's $300. Your employer adds another $300. That's $600 a month going into your retirement account, starting right now. Over 30 years, with an average 7% annual return, that initial $300 match could grow to over $300,000 in extra money. Just by checking the box on your pay stub. Why does all of this matter? Why should you care about reading a piece of paper or looking at an email attachment? Because awareness drives action. When you understand where your money is going, you can optimize it. If you see that your take-home pay is lower than you thought, you might adjust your budget. If you notice you aren't contributing enough to get the full 401(k) match, you can update your withholding settings. If you see a deduction you don't recognize, you can question it. Pay stubs are your financial report card. They tell you the story of your month. Are you saving enough? Are you taking advantage of tax-advantaged accounts? Is your employer helping you build wealth? Here is your action plan. Next time you get your pay stub, don't just glance at the net pay. Open it up. Find your gross pay. Find your net pay. Calculate the difference. That's your total deductions. Then look at the breakdown. How much is going to taxes? How much is going to benefits? And most importantly, how much is going to your future self? If you have questions about specific codes on your pay stub, or if you're unsure about your W-4 elections, consider consulting a financial advisor. They can help you tailor your strategy to your specific life situation. Remember, you can't manage what you don't measure. And you can't measure what you don't understand. By decoding your pay stub, you're taking the first step toward financial clarity. If you found this video helpful, please hit that like button. It really helps the channel. And if you want to learn more about how to invest that leftover cash, subscribe to Fiscal Beacon. Next week, we're breaking down the 50-30-20 rule for budgeting so you know exactly how to split your paycheck. Thanks for watching,